we
Right.
would go around the country and people would always say, what are you seeing out there? Well, what's a hot
Right.
stock? And we're like, we got
Right. Right.
this one's pretty cool, right? And it just
Yeah.
like
Yeah.
it went up 30 times in a year. And my boss
Yeah.
thought I was a genius. And it's like,
One,
yeah.
two, 3, 4.
All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the third episode of The Exponent with 5i Research. My name is Chris. I'm a senior investment analyst with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today I'm joined by our first guest on the podcast, Peter Hodson. Peter is the founder and head of research at 5i Research and the associate portfolio manager at I2I Long Short US Equity Fund. Prior to 5i Research, Peter was chairman of Sprott Asset Management, a director of Sprott, and lead portfolio manager for the Sprott Growth Fund. Peter, welcome to the show.
Thank you. Good to be here.
Yeah, glad to. So for anyone that's listening that's not a member of 5i Research, Peter's very active in the Q&A. So if you have a burning question on the markets or a particular stock, Peter has you covered in the Q&A. And also Peter's kind of known to be a legend around the office. Everyone highly respects his insights and wisdom into the markets. So that's kind of a little background into Peter.
Wow. Thanks, Chris. We've actually answered 167,000 questions since we started in 2012. So, and they're all on our website. If you can't sleep at night one day, there's 167,000 questions you can read.
Yeah, lots of reading, lots of homework to do. So
yeah,
that's great. That's a good stat. I didn't know that. I knew it was in the 100,000, but wow, the number will just keep growing. So we'll have to have a party when we hit 200,000.
Well, we thought about maybe offering a prize for the 200,000, but that's just going to encourage more questions. So
yeah, more work.
Yeah.
All right, cool. So I guess we'll get started with some questions here. So my first question is, so you founded 5i Research in 2011 alongside buying Canadian Money Saver magazine. I know a little bit about this, but what was your inspiration really for starting 5i Research?
Sure. So I'd been in the fund industry for a long time, 20 plus years as a portfolio manager. And, things were fine. I love the market. I'll probably always love the market. But I sort of came to realize over the time I was in the industry that it's a great industry to work in. And it's not really that great of an industry to be a client of. And the reason for that is because of the high fees, because of brokers, they just want to keep your money. They don't necessarily want to make you money. They would rather keep all their money. There's like different jargon they use, like who knows what a hold rating really is, and who knows what an accumulate, recommendation really is. And so it was one of those situations where it's like, what, like the actual investor themselves is not really getting a lot of benefit from this industry, even though there's like billions and billions of dollars being spent in the industry. It's all going to people who are in the industry and people who are managing your money, and not going to the poor investor. And of course, there's the famous book that was titled "Where Are All the Customers' Yachts?" And so it really kind of over time, it just kind of got to me. And it's like we were getting, this in particular, we were salesmen as fund managers. Our job was to get money into the door. And a little bit earlier, before I formed 5i, at a different company, prior to my last one, I was actually at a company and I was running a small cap portfolio. And honestly, I was having one of those years as a portfolio manager that you just simply dream about. Like everything you buy goes up. You make, very few mistakes. Everybody loves you. It's just knocking it out of the park. And it was about August of 2003, 2004. And, I'm just kind of like, woo, I must know something finally after 20 years. I've started to do well. And no, it was good before that. But it was like just one of those years that you just dream about. And I got a call into my boss's office. And he's like, can you meet me on Friday? I'm like, sure, I'll meet you on Friday. And I swear, Chris, I thought I was going to get like a giant raise or a giant
Yeah.
promotion or 5 new analysts or a box of chocolates or something, right? And we
Right.
sat down and he basically said, I I have to do less well. Because if I'm going way up, then their clients think that I might go way down one day. So,
Crazy.
like my fund was up like 48 or 50%. And he basically said, we only want it up 30% or 25 because
Yeah.
the market's only up 20 and people are going to get too worried and they're going to sell our money. We just want to keep the money. And I was
Right.
like, you're killing me, man. It's like one of the worst conversations I had in my career. And I quit 3 months later because it's like, okay, this is not the type of thing we're going for. And so that was a big factor, and that kind of carried through, and it was in the back of my mind forever. But one of the other reasons was, so at some of the companies I was at, you could own personal stocks, you could trade your own personal stocks, and at some
Mm.
companies you could not. You're just simply restricted. You had to buy your own fund, and that's a bit of a better process. But at the last company I was at, I was putting money into companies that I liked, and I wasn't trading, and I didn't have any monies going in and out like I would do in a mutual fund, so I didn't have to worry about fund flow and redemptions and things like that. I didn't have to worry about a bonus. Like in the mutual fund industry, if you have a good year, you get a bonus. If you have a bad year, you don't get a bonus. So lots of managers, they manage their portfolio to get a bonus. And honestly, they manage it on a 1 year basis. And that's not a great way to manage money. So here I was running a mutual fund and I was doing all these things that were perhaps detrimental to performance. I still had okay
Mm.
performance in that particular period of time, but I was buying IPOs, and the reason I was buying IPOs is because that gets you the first call from the analysts. If you buy
Okay.
a deal, they phone you with information, and they like you, and they give you, you're the first phone call of the day, kind of thing. I was trading too much because when you're charging high fees as a mutual fund manager, you can't do nothing, and especially
Mm.
if the market goes down and a big client comes in and says, what are you doing? And you're like, oh,
Right.
I'm waiting for the recovery. Then they're like, well, I'm not going to pay you 2% to sit around and wait. You gotta do
Right.
stuff, right?
Yeah.
And,
One should be
um,
active here. Yeah.
exactly. So as a manager, I was doing all these things, and my fund was doing okay and wasn't doing great at the time, but it was doing all right.
Mm.
I was
Yeah.
managing this process. But then I looked at my
Eating.
personal stuff, and my personal stuff. I wasn't trading. I wasn't paying taxes. I wasn't buying new issues. I
Right.
didn't have to worry about money going in and out. It was just these good companies that were compounding without anybody even looking at them because I was busy with the fund. And my personal account was doing so much better than my fund. And it actually kind
Yeah.
of got me worried because it's like, oh my God, if people find this out, like they're gonna
Yeah.
hate me. and I thought about it. It's like, well, why is that? Why am I doing better than this fund that everybody seems to like? And it was
Yeah.
for all those reasons. And I thought, you know what, this
Right.
is this is the wrong business for me. I would like to help people make some money, and at the very least, help them stop making mistakes. Because in my
Right.
career, of course, I've seen a million people do a million stupid things, and you try and
Yeah.
learn from that. And it's like, okay, well, if I can stop a few people from doing these things, and so I said, screw it, I'm gonna sort of change everything. And there's lots of newsletters around, and there's lots of analytical reports, but they're all tied into companies.
Mm.
There's lots of promoters that will talk about stocks, and then they have a bunch of stock on the side and they sell it after it goes up, or they have
Yeah. Yeah.
companies that'll write research reports for companies, and they'll get paid $20,000. But of course, do you think it's a good report or a bad report? Of course, it's a good report because they're getting
Yeah.
paid $20,000. So I kind of threw that all out the window. I said, you know what? We're just gonna give you our opinion. We're not gonna trade in Canadian stocks. We're not gonna have a relationship with these companies. And if we think your company is a piece of crap, we're gonna say, hey, that's a piece of crap. And we just started out, and we started out in 2012, and we kind of hit a nerve because, of course, investors had gone through the financial crisis, and they had
Right.
all lost a lot of money. But guess what? Their broker and their fund manager and their advisor, they still got their 2% or whatever they're charging. And
Crazy.
a lot of people were very cynical and very bitter. And we just
Mm.
sort of hit the ground, and everybody's like, wow,
Yeah.
for
Yeah.
$100, you can
Yeah.
tell us what you think. And you don't have to act on what we say. It's just, here's an opinion. And the thing that people liked was there was no ties to that opinion. We don't
Right.
care. We don't care if you buy a stock we like. We don't make any money if you buy the stock. We don't
Right.
manage your Canadian money. Who cares? I don't care what you do,
Yeah.
right? And so it was just an opinion. And of course, not everybody agrees with us, and that's fine. But we're
Yeah.
just giving you what we would do, or what we think, and that's how Five Eye kind of came into existence. And we bought Money Saver, kind of like as a loss leader. When you go to the grocery store and you buy milk on sale, and then you buy a bunch of other stuff. It was kind of
Mm.
a bit of a marketing situation, and I didn't know how to publish a magazine. I didn't know what I was doing, frankly.
Right.
And
Totally.
but we thought, okay, well, if people sign up for Five Eye, we'll give them a free magazine. And
I see.
people thought that was the greatest deal ever. I'm like, okay, sure,
Yeah.
here's
Yeah.
free.
Sure. Free information. Yeah. I'll
Yeah,
take
and
it.
so
Yeah.
I mean, but it's been around for, what is it now? Is it 50 years? The magazine,
Yeah. Something like that.
81,
Yeah.
1943
Yeah.
years,
Right.
and it's one of the last magazines in the financial industry that actually still publishes a printed version. Everybody
Wow.
else has gone either bankrupt or fully digital. So,
Yeah. Yeah.
so we like it, and I was very involved in the magazine when we started off, but then now we have some staff, and Lana, the editor, takes over all the real hard work.
Yeah.
But we have a complement of writers that contribute. We only pay a few of them. A lot of them are kind of like me; they just want to give out information to people. Some might be selling a book or something like that, and that's all disclosed. But people seem to like the magazine, and so far so good. And Five Eye does model portfolios, because we were getting a lot of questions about, hey Peter, what should I do? And
Right.
we're not licensed portfolio managers at Five Eye, so we can't tell you what to do, but we can tell you what we would do. So we set up 3 model portfolios, and we have lots of clients that follow them religiously. And the balanced portfolio has done really, really well over the past 10 years. The growth fund, being a highly volatile fund, has done less well, but it's starting to really pick up pace right now. And then we have an income fund, which people are pretty happy with as well. So between the 3 services, we report on companies, we answer questions, and we give model portfolios, and people seem to be happy. We're still kicking.
Yeah. Definitely. No, it's a really good value added service. And just touching on that point you made about over trading just for the purpose of over trading, generating commissions, things like that.
Yeah,
It's so interesting because part of our philosophy at Five Eye is that long term view and buy and hold. And if there's no reason to sell or buy, then sometimes there's just no need to do that. So if you
absolutely.
don't have to touch anything, kind of leave it be and let the winners win. So um,
Yeah, there's too many
uh,
decisions. If you sell something, you're selling a winner, you're paying tax, and you have to buy something else. And
right.
the odds of you buying another winner are actually kind of low in the stock market. So,
Yeah.
yeah, and you don't get that benefit of compounding. So, yeah, you nailed it there.
Definitely. No, that's super interesting, and love to hear the background story on that. So that's always great. And I have a picture here that I pulled from the internet. This wasn't in the agenda, so
I
I'm
hate
not
the
aware
internet.
of this. Um,
Oh, yeah.
yeah, so I pulled this picture from when was this? I think 2012. I grabbed
Okay.
this from an
Yeah.
article from 2012, and the title is let me see here. The title is "Former Bay Street Money Manager Starts New Chapter with Canadian Money Saver." So I just wanted to see if you remember this picture, if you can kind of envision in detail what your feeling was at this moment in time, I guess.
So it's funny, because at the time I just bought the magazine, and we had one other employee at Five
Okay.
Eye,
Yeah.
and I literally had no clue what I was doing on the magazine side. I had thought about Five Eye and had set up Five Eye properly, and I knew what I was doing on the Five Eye side, but on the Money Saver side, I didn't have
Yeah.
a clue what I was doing. So the one of the newspapers came in and said, come on in, we'll do an interview. And it's like, okay, well, I guess I'll bring in some magazines. And
Okay.
they were
Cool.
asking, it was funny, they were asking me my strategy and my plans for the future, and I was like, I'm just trying to make it through the next day.
Yeah. Just day by day. Yeah, that's all you
Yeah,
need.
and we had like 60 or 70 writers, and I had to explain to all of them that there was a new owner, and I didn't really
Okay.
want to change anything. The
Right.
magazine had been published for 30 years, and it was successful. So who am I to come in and make changes? Like, I don't know what I'm doing, so I might as well just keep everything the same. And so There's a
Yeah.
lot of sort of hand holding with the authors and the writers that do the magazine, just to say, you know what, nothing's going to change, and maybe we'll increase circulation because we have this other business that we're going to market the magazine to some other clients. But so that
Yeah.
was really tough. But things like, you'll laugh at this story, Chris. So I bought it from a couple that had started the magazine in 1981 at their kitchen table. And so
Okay.
I went out to visit them at their office, which was their home. And I came back with all sorts of boxes of data and things like that. And I came back with this giant computer. I don't even know
Mm.
what it was. I don't even think they make them anymore. And
Mainframe.
that ran the whole company, this computer. And so one day I was having trouble with a computer, and I was just, sort of hitting it like you do in the old days and try and get it to
Yeah.
work, and it worked. And I talked to the owner at the time, and I basically said, what what happens if this computer dies? This computer that you
Yeah.
gave me, like, what happens if it dies? And there's the longest pause, and the wife of the husband and wife team, she goes, "That would be really bad." And I'm like,
Basically,
what have I bought here, right? So we had to move everything to the cloud, to the internet, because
okay.
the computer was like, basically smoking. If you tried to run a program, it would start smoking from the back. And
Yeah.
so that took a process. We changed the website, and we did all sorts of things to try and bring it up to more modern technology. And so that took a lot
Okay.
of time as well.
That's hilarious. Yeah. Yeah. Back in the day when, floppy disks were a thing. And then even before that, it's just
Yeah,
one giant computer that probably costs the same as three iPhones today or something, I'm sure.
yeah,
So,
exactly,
yeah,
exactly.
that is wild. Next up, we're we're going to be talking about stock market stories here, and going into different crashes or significant rises in the markets throughout time. And so we're going to start off with the 1987 stock market crash.
Ooh,
For those listening or watching, this was a 30% drawdown that happened in a matter of 2 weeks across all sort of different indices. And it was quite the flash crash. So, Peter, can you tell listeners what the 1987 stock market crash was like, and what's the most
sure.
memorable story that you have from there?
Sure. So it's absolutely burned into my brain, for
Yeah,
one. So you were saying 30% over 2 days, or 2 weeks, but there was actually a 22% decline in the Dow Jones in a single day, and that
right.
remains the largest single hit in a single day in the stock market. Even worse than the Great Depression of the 30s. It wasn't as bad as that in a single day. And I was a 23-year-old broker, and I'd been at work for maybe 2 or 3 months as a
Mm,
broker. And at the time, the brokerage industry had just deregulated. So in the old days, and I'm really dating myself, you used to pay $200 fixed commission to buy a stock. And like, can you
okay.
imagine some poor investor who gets free trades
Yeah,
now, trying to convince them to
right.
pay $200?
Yeah,
It's just
adjusted for
ridiculous.
inflation. That's yeah,
Yeah, it's ridiculous. You need $400 in and out to make a profit on a stock, right? Now, in hindsight, maybe that wasn't so bad because people probably kept their
right.
stocks a lot longer. But
That's right.
but
Yeah,
that's a
yeah.
different
Forced
that's a
you to
different
hold.
story. The
Fair.
other thing that's noteworthy is that 2 week period, or that 3 week period, both leading up to the crash and after the crash, was by far the best psychology class I ever could have taken in my life. That taught me
Mm,
more about investor behavior and psychology behavior than any book you could ever possibly read. Like, we saw it all in a very, very short, compacted period of time. We saw, the greediest of the greed to the fearest of the fear, and it was fabulous. And it was partly fabulous because I didn't have a whole lot of money in the stock market, so it wasn't that painful. It was a little painful. I
okay.
could tell you another story about that. But I was just watching a train wreck, and it was
Yeah.
very, very interesting. So one of the best stories I have is, you have to really date yourself here, and you have to go back and remember, in 1987, there was no internet, there was no iPhone, and there
Yeah.
wasn't even like three-way calling that was like really technically feasible.
Mm,
If you got an operator, you might be able to have a three-way conversation, through an operator's assistant, and the operator's putting all the wires together and stuff like that. So at the time, because of the deregulation, we weren't allowed to give the company I was at. We weren't allowed to give investment advice. We were kind of the first discount type of brokerage after they deregulated, and the phones, of course, were going crazy. No one could get through on the phones. So one of the one of the anecdotal stories was, we couldn't go to the bathroom because we had to walk through the lobby to get to the bathroom, and all the people that couldn't get through to the phones had
Yeah,
converged on the office, and we had like 100 people in the lobby in our
jeez.
building. And if you needed to go to the bathroom, someone would see you wearing a suit, and they would just like grab you, and you and
You
you'd
have
have
to
to
change
deal with
real
that
quick,
person.
and then yeah,
Exactly. And so, we would talk to people, and a lot of our jobs at the time was just giving people quotes, right? Because there's no internet. But
yeah,
then word got out on the street, and the radios and the TVs were talking about the market crashing and blah blah blah. And so I was having a conversation with one client, and it was a young client, and he had money and he had a job, and we were just discussing what was going on. It's like,
mm,
okay, this is down, and he was upset, but he's kind of like, I'm young, I'm working, whatever. Like, I'll put in some more money if it gets cheap, and blah 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 blah. And a very
right,
rational type of conversation. And
fair, yeah,
and then my I had a headset. My headset beeps, and it goes, "Hi, this is the Bell Canada operator. I have an emergency." And then she just connected me with another person. And so now I've got like a multi conversation before it was really technically feasible.
yeah.
So now I got one guy in one ear and one guy in the other ear. And the new guy basically goes to me. He's like, "Sell everything, sell it." Like, he's like, "Here's my account number, blah blah blah. Sell everything."
Yeah,
And it was, and here's what happened. The guy in the other ear, who a second ago was rational, was going to invest, was going to stick it out to the long term,
right.
had money, had a job. He goes, and I quote, "I was here first. Sell my stuff
No way.
first." And I'm like,
Yeah,
I got these two competing people in my ear, and I'm like,
hands up to
you're
her.
killing me. And I think I got out of that. I think I might have I think the three-way conversation might have failed. So I think I kind of got out of
Oh,
that one,
okay. You kind of
like
escaped.
by
Yeah,
default, it just lost both
yeah.
of them.
Disconnected. Yeah,
But it was amazing. It's like, okay, so now the first guy, he
yeah.
was selling because someone else is selling. And that actually translated to the entire week, right? So people,
Wow,
they would see something that was down. It's like, "Oh my gosh, I got to sell because it's down." And then
crazy.
it would go down some more. And then someone else would like, "Oh my gosh, I lost so much money. I better sell in case it goes down more." And it was just like,
Yeah.
and that's how this sort of starts to feed upon itself. And it was just ridiculous in terms
Wow.
of what people are doing. Yeah.
That is crazy. And do you think with that lag in data and real-time information that they had back then versus today, do you think it would have been worse back then if they had that real-time data and reflexivity that we have today
Yeah,
in the markets?
I really do, because
Wow,
it was going down so fast. And
that's crazy.
but honestly, like it might have taken you an hour to get through to us on the phones,
Oh
right?
wow.
And so you might call
Oh
in, maybe you got a stock at $100, and
yeah,
you might call in, and when you get to us, it might be 80. But by the time the next person comes in, it might be 60, right? And so if you're seeing that on real time, and I think the problem would have been, if we had the technology back then as we do now, is all these people would have been hitting the button.
yeah, that's
Instead
right.
of
Yeah,
phoning somebody, you got to
yeah.
make a dial, you got to talk to someone, you got to rationalize it out in your brain instead of just going bang, 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 bang.
Instantaneous. Yeah,
Yeah,
yeah.
I think it would have been much worse. Yeah,
That is crazy. Yeah, it's like the sell pressure wasn't even as bad as it would be today with all that real time selling pressure all at
exactly. Yeah,
once. That
yeah.
is crazy. That's such a
And
cool story.
more people would have known about it as well, because
Right,
if you
right.
say you were a teacher in 1987, you're busy with your class, you don't know
Yeah,
what's happening.
yeah,
But now
right.
now you're looking at your phone, and you're
Now,
like,
yeah, you
ah.
get an alert through your Apple Vision Pro
Yeah,
headset, and there you go.
exactly,
You don't even have
exactly.
to move your head. Yeah.
Exactly.
That is funny. That is such a wild story, and just such a difference that what would that be, even 37-ish years has kind of made just in technology and advancements in the market.
Yeah,
So that's
absolutely.
crazy.
But
And
you know what, it really helped me though, Chris, because um, as a youngster without much money, I actually had some margin issues like everybody else that week. But I
okay,
got out of that. I got out of that because I didn't sell.
yeah,
And
right,
and then subsequently in the next 35 years, every time there's a problem, it's like, you know what? All the other
yeah,
problems have ended.
Right,
So
right.
I just have to
Yeah.
live long enough for it to end.
Yeah.
And maybe I'm a bit more of an aggressive investor now because I've survived a million
Mm.
problems.
Yeah, yeah,
Because I would classify myself as pretty aggressive. But I've seen all the problems before. I've seen the worst drop in the history of the market. So
right.
yeah, sure, we could get a worser drop. I know worser is not a word, but
Yeah, yeah,
that's possible. But I've seen
yeah,
a lot, and the company doesn't change. The
yeah,
company that you're investing in, they're still making money that day of the market
right,
crash.
right. And they still offer the same services, and
Yeah,
investors or
yeah,
individuals
yeah,
still want to
yeah.
buy those products even after the crash. And that is
Exactly.
that's one of my favorite data points is especially now that the markets are at all-time highs, is that, it's always been a good buying opportunity historically. As soon as you hit all-time highs, the data suggests that any dip has been a good buying opportunity, at least in the broad markets. So that's
And just
always a
on that, I the other tidbit that I like is that all-time highs are actually quite common in the market.
right,
If
right.
there's like 8 or 9% of the trading days are all-time highs, and so it's like everyone's like, oh, I better sell. It's like it's just another
Yeah, that's
day,
right.
right?
Headlines, yeah, that's right. You
Yeah,
hear all-time highs and think that you have to sell, but
yeah, yeah. And
most
especially
people
this is
are.
interesting because it's maybe we're at an all-time high with some markets, but we're really only back to where we were 2 years ago, just barely above it,
Yeah,
right? So if you say
yeah.
haven't really done anything in 2 years, so
Yeah, that's right. It's pretty much, a flat market, you could say,
yeah,
from 2 years ago. Yeah.
yeah,
And I just put up a chart here for viewers that are watching the podcast. This is the 1987 meltdown specifically for the TSX. So we can see in the top that's the price. The bottom is kind of that percentage change, and yeah, so quite a precipitous drop, and it happened in about a short amount of time, 2 weeks, and it took about 2 years to fully recover from that. So that's kind of what happened in 1987 for those that are unfamiliar, and just to provide some sort of visual context there. So yeah, so 1987, really interesting drop. And then going into the next kind of precipitous, I guess market rise and subsequent drop. Can you talk a little bit about the roaring 1990s? With tech stocks coming to the forefront, the internet really coming into everyone's radar. What was your biggest win, both financially or mentally, like a good mental takeaway? And do you have a story about the subsequent crash of the dot-com 2000 bubble there?
yeah. I mean, maybe not so many about the crash because I tried to wipe that from my memory, but
Yeah.
I mean anything technology was moving, of course, and the internet was brand new, and people were trying to figure out how it was going to work, and it really did turn into a bubble. And the thing that's interesting, people saying, oh, that the AI bubble right now is similar to the dot com. And I would 100% disagree because in the dot com days, you literally, and this is why it's called the dot com craze, you literally could
Yeah.
take a company, slap the word dot com onto it,
Crazy.
and double the valuation. And
Yeah.
you've done nothing except change the name of the company. And sure, and
Right.
of course, and people would do this, and of course, some of the executives would get rich, and so suddenly it's like, well, we better put a dot com on our name because
Mm.
we'll have more money.
Yeah.
And
We don't want
it
to
was
lose
like
them.
it was really really quite stupid. And unlike some other I maybe call them frenzies instead of bubbles. There's some frenzies where there's actual money being spent and there's actual
Right.
profits being made. Whereas in dot com, there really wasn't. Nobody cared if you were profitable, as long as you were
Yes.
growing, as long as you were tech related. It didn't matter if you're saying, oh, we're going to make money 10 years down the road. No one cared because the internet was going to change everything, and there's going to be faster growth for every single industry, and no one was ever going
Yeah.
to lose money. And the best story I have is there was a company called Celllock, and Celllock literally was almost a shell company that had various ventures. And that wasn't their original name. I'm too old to remember their original name, but I like to call it two guys and a donkey. They were a gold company or they're a shell company. And basically it's reflective. I use that because of the story I'm about to tell you, but basically anybody could raise money if they had a tech idea, so like
Mm.
kind of like today's, if you have an app, everybody's got an app idea, right? But back
Right.
then you could raise hundreds of millions of dollars if you had an idea. And so two guys and a donkey could change their gold company's name to, super high tech
Yeah.
internet.com. And then they could raise money and then maybe go out and buy a company, or they could hire a bunch of engineers and try and build something. So anyway,
Wow.
so this company called Celllock. So cell phones were sort of starting their wave. I don't even know where BlackBerry was at the time, but cell phones were becoming a thing. And Celllock had this great idea of triangulation, so they could triangulate where you, Chris, were at any time. I mean,
Mm,
it's laughable right now, considering Apple knows where you are 24/7. But at
right.
the time, in 1996, 1997, nobody knew where you were, and they hadn't done the
Right.
tracking yet. And so they had this idea, and honestly, their idea was brilliant because it's all being done right now.
Yeah.
But their idea was to find you, Chris, with triangulation, and then send you an email because you're walking by a pizza store for like
Okay.
a dollar off pizza. So it
Oh,
really was
yeah. That's ahead of
25
its
years
time.
ahead of their time, right?
Yeah.
And
Yeah.
I think people understood that this would be great for retailers. It'd be great for advertisers, and this company could make
Right.
a bazillion dollars. Absolutely. Like so I can't fault them for the idea. But what I remember about this company was, it's like I'd heard about them, and at the time, being a fund manager, there's no shortage of brokers phoning you up saying, "Oh, you gotta check these guys out." So I went to a meeting, and all the meetings were full. So I had to go to a luncheon where like 50, 60 people, see the company at the same
Oh,
time.
okay.
And they
Yep.
had to change the location 5 times because the demand was so great. And so I think we
No
ended up
way.
going to the Royal York Ballroom in Toronto or something, some
Oh,
massive
geez.
room,
Yeah.
right? And there's like 400 people
Extravagant.
there. And these guys had, you know, essentially the founders of the company. I mean, they were smart because they knew they weren't going to be the engineers figuring this stuff out, but they
Right.
hadn't really done anything yet. It was like basically four
Just
guys
an
and an idea, and they're going through their presentation, and it's all professional, super duper PowerPoint, or whatever PowerPoint was called back then, and
Yeah.
it's all sounds legit and blah blah blah. But it literally was like four or five guys, and they were raising $50 million. But that's not the part that was really surprising to me. What was surprising was the demand was there. Obviously, that it was a good idea. But
Mm.
what's surprising to me was in their presentation, they said this $50 million is just the start. Our business plan requires two or $3 billion, and people are like just throwing money at them, to because of this business plan. And I was like, you know what? And back then, $2 or $3 billion was a lot of money.
Right.
It's like
Right.
I'm like,
Yep.
these guys have
That's
just
good.
everybody in this room that the $50 million will last them like 4 or 5 months. And then they're going to have to raise more money. And you get kind of on that dilution trail where all they do is raise money. But of course, the whole idea was they were, their stock was here. They raised $50 million, and their stock triples. And then there's less dilution because their stock's so much higher. Then they raise
Right.
200 million and their stock goes up, and then they raise a billion, right? And it all,
Create that
it
flywheel
all,
effect.
yeah, it all hinged on everybody loving this company for the next 10 years. And
Right.
their timing was well off. They were, only about a year and a half before everything imploded.
Oh,
And,
okay.
they raised their $50 million. The stock went way, way up. And then it came down so fast because, of course, the financing window closed, and that $2 billion that they needed was no longer available. And I
Wow.
don't even know what happened to them now. I think I looked them up on Bloomberg a couple of years ago, and they were kind
Yeah.
of gone. So
Must be zero. Yeah.
yeah, but it
Yeah.
was just like literally like the portfolio managers were essentially throwing money at the table
Yeah. Yeah.
while they
Yeah.
were doing it. And and we didn't buy any blah blah blah. That was kind of good. But what's funny was they had a sister company that was called Wyland, and which is now turned into a company called Quarterhill, and they're still around.
Okay.
Not a very good company anymore, but at the time, Wyland. But Wyland was a sister company who had some other ideas, and we actually bought that, and it was like
Okay.
supremely successful. The stock went from like $2 to $65 or something like
Oh,
that in a
wow.
year. And I remember that one because I wasn't I didn't have that much experience at the time, so I had a boss, right? So I talked to my boss about this company Wyland, and they were doing some sort of thing that I can't explain.
Yeah, that's
But
some technical.
it was wireless multiplexing. So basically, back
Okay.
then, data transfer was a big problem. So say you had there were no video transfers back there, but say you had a video transfer, it was
Right.
just taking a massive amount of packets of data that had to go across the internet. So
Yeah.
what WLAN was able to do was basically split them up and then rebuild them at the other side. So it was very, very cool technology, and
Okay. Yeah.
they managed to patent the technology, and they had like a really, really good sort of plan to patent the technology and license it out. Blah 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 blah. So I was talking to my boss about this. It's like, this is pretty cool. Obviously data is going to be a big thing in the internet and blah blah blah. And they were raising some money, but no one had heard of this company. It didn't have the same cachet as the other company, and they were doing one thing in California where they had a live feed of a video traffic camera. And
Okay.
again, you say now where everybody's got a Ring
Yeah. That's
doorbell
yeah.
and
Right. Right.
whatever, right? Or
Seems
blink
relatively
cameras.
easy now, but
Yeah,
yeah.
like right
Yeah.
now you're like, what's this guy
Yes.
talking about? That's completely. But at the
No. No.
time, they were
Yeah.
broadcasting a video stream of
Wow.
an intersection. So somebody in Los Angeles could say, I'm not taking that street because there's a traffic jam.
Right. There's
And
some sort of.
so my boss made me phone up the California Traffic Authority, or who had ever bought the YLAN product that had converted it into video. And I'm
Okay.
talking to this guy in California and asking him, like, does it work? Basically, are there any problems? And he's like, it works like a charm. We love it. It's like blah blah blah. And so we
Yeah.
started buying it. And then and at the time, we were doing lots of media appearances, and we were doing lots of broker events ourselves. As I mentioned, we're salespeople as fund managers.
Yeah.
And so we
Right.
would go around the country, and people would always say, what are you seeing out there? Well, what's a hot
Right.
stock? And we're like,
Right.
this
Right.
one's pretty cool, right? And it just
Yeah.
like
Yeah.
it went up 30 times in a year. And my boss
Yeah.
thought I was a genius, and it was like, yeah. And we exited that one pretty well. We kept some,
Yeah.
in the wait. At least we sold on the way up. But I like that
Yeah.
one because that was actually, unlike some of the other things that were going on at the time, there was actually a
Right.
real life application there, and they were
There's some
actually making
fundamental.
revenue from their technology. Whereas everybody else was like, "Oh yeah, we're not gonna make any money for the next 10 years,"
Yeah. Yeah.
and that was almost better for some investors. They're like, "Ah, we don't need profits," right?
Yeah. That's right. Yeah. Yeah. Just by the hype. Yeah.
Exactly.
Um, that's such a cool story, and it kind of like forays into the difference between a frenzy, a bubble, and even the difference between vaporware and some sort of real life product that actually has use case. I think it's
Exactly, and
super applicable today. Yeah.
it really is. And again, it taught me a lesson, because it's like, you know what? You're buying a company here.
Right.
You're
Right.
not, you're not buying a story. You got your story over here, but you got this other company
Yeah.
that's, actually making money.
Actually.
Which one do you want? Yeah.
Yeah, no, it's so interesting. I think a lot of people will learn something from that too. In today's age, where AI is coming into the forefront, and we have actual fundamental use cases with Open AI, ChatGPT.
Yeah.
Microsoft kind of leading that, and NVIDIA kind of powering it using GPUs and other technologies that they've built out. Versus, I'm sure we're going to see some AI companies probably come to the forefront in the coming years.
Oh, for sure. Yeah.
Uh,
Yeah.
might be worth nothing. Might just be promises. So investors definitely should take note of that in the coming years. Yeah.
Yeah. I think they should be careful too, because the incumbents, the big companies, their
Yeah.
ability to spend hundreds of billions of dollars is there, whereas the startups don't have that ability. And
Yeah.
that's going to be a big advantage for them.
Yeah. Interesting. Yeah. That's a really good point. Um, and then we've got another stock market story coming up here. So, I mean, everyone's obviously familiar with the 2008 and 2009 kind of great financial crisis. So that's kind of the elephant in the room. But, do you have a memorable moment from that particular crash? Any sort of key takeaway that you have from that moment in time?
Yeah. So one of my career moments was, yeah, just a little quick story, but it's kind of resonates with me. So I was working very, very closely with Eric Sprott at Sprott Asset Management, and I was a director of the company. And um, we had a very, very close relationship looking at stocks, and um, he had basically called a downturn. He
Wow.
was short. He was short GM. He was short Fannie Mae. He was short like 8 or 9 companies that actually went bankrupt.
Wow.
Um, and his fund did fine, but it didn't do
Mm.
amazingly, and so he was positioned to do, for a crash basically. And the crash
Yeah.
came and his fund just did okay. And the reason
Mm.
for that is because everybody flocked to the US dollar. And his fund was positioned because he didn't like the US dollar, he didn't like the US economy. And he
Oh,
was also positioned that the US dollar was going to, massively go down. And in a time of crisis, everybody just wanted something that they thought was safe. And so they just plowed into the US dollar. So there was only 2 asset categories that went up in 2008. One was the US dollar and one was gold. Not gold stocks, just gold. And
wow.
so anyway, but he was widely viewed as, the best investor in Canada. His 10-year record performance number was like 29.5% compounded. I mean, he was truly a brilliant investor. So anyway,
Yeah.
one day in 2008, comes over and sits in my office and he goes, "Peter, what should we do?" And I'm like, "Okay, you're the best investor in Canada, and you're asking me what we should do. Clearly, the world's messed up right now." So that was kind of fun. So we had a good discussion about maybe what we should do. But the thing that was interesting about that one was the absolute carnage that transpired once confidence disappeared from the system.
Mm.
So, banks are run on confidence. And once banks stopped lending to each other, it was just an entire domino set of problems. And it was
Jeez.
unbelievably like we had US money market funds going below par. So there's someone who's basically who's got a
Wow.
bank account or what they think is a bank account. And now they've lost 10% in what they think is the safest product they possibly could have. There's all sorts of there's all sorts of movies that have been made about what happened, but basically brokers were selling junk and disguising it as good stuff. And
Right.
it kind of gets back to the fact is, what, there's a lot of greedy individuals and companies out there,
Mm.
and they're
Mm.
trying to sell you something, and you have to be very, very careful because it's your money and they're going to make a fee off of you whether it goes up or down. I don't want to say they don't care because if it goes up, they'll probably sell more stuff, but
Yeah.
they get their money regardless of how you do. And
Yeah.
that really kind of, again, that kind of tied into the whole, I got to get out of this business type of scenario.
That's
But it,
interesting.
but the massive declines, like I remember, so I had an aggressive fund at the time, and it was 400 or 500 million dollars, and I had a spectacular 2007. So what happens in the fund industry when you're hot, you get all the money coming in, right? So
Oh, yeah.
for
Yeah.
the first
Right.
6 months of 2008, the money was just pouring in because I had done
Yeah.
so well in '07.
You looked at the
So the
prior
money's
year record.
pouring in, blah, 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 blah. And then, of course, the party ends and then the money wants out because
Yes.
we're crashing. And I was the most aggressive fund at the time. So
Okay.
people knew that like if things were going to be bad, I was going to be like extra bad.
Feel
And
it
I
first. Yeah.
remember one day, it's probably October or something of '08, kind of after Lehman Brothers went bankrupt. And I had a pretty big fund, and I had like 3 million shares of this oil stock. And of course, oil was going down. Nobody, no one was ever going to drive a car again, apparently.
Mm.
Uh, and I got the notification each day of whether I get money in or money out of the fund. And then this
Okay.
one day, I got a notification from the people in the back office that said, like you had a $30 million redemption.
Mm.
And on a 400
One
million
day.
dollar fund, it's a
Wow.
pretty big hit.
Yeah.
And of course,
10%.
but whatever, you've got these liquid stocks. They weren't that liquid, but I was never really worried about liquidity. And I had
Yeah.
this oil company. It's like, okay, well, I don't want this anymore. So, being a manager, I talked to my trader and talked to other traders, and it's like, okay, I need to get out of 3 million shares of this company.
Mm.
And I knew everything was going down, so I knew I was going to take a hit. And I'm a big boy. I know that's going to happen if you're going to sell 3
Yeah.
million shares. But in the fund industry, and especially in the mutual fund industry, like you can't wait. Like the guys want their money today, or it's 1 day, 2 day settlement, right? And
Right.
whereas a fund, a hedge fund's different. It's like a 30-day window before you can redeem.
Okay.
So
Yep.
I have basically 2 days to raise enough cash. And of course, I didn't have a lot of cash because people were getting out of the fund for weeks and weeks
Right.
before
The
that.
redemption started.
So the stock was $15, and I thought maybe I could get out of it at 12 or 13. Just
Okay. Yeah.
whatever. I
Yeah.
need the money. So the first bid came in at 10. So somebody came in, it's like I'll buy it at 10. But that was a really horrible day, and the market was going down like 6 or 7%. And like in
Yeah.
an hour, the bid was 8. Right. So it's gone from 15, and now I have to sell a stock that's 15 at $8. And
Wow.
I have to do it.
You
Right? If I
absolutely have to.
don't,
Wow.
you're not allowed to borrow money at a mutual fund. You can't borrow money and hope it all works out later. So I'm like, okay, hit the
Yeah.
8, and they cross the 3 million shares at $8, and
Jeez.
you're like, what are you going to do? And you just
Yeah.
feel like hitting yourself in the head with a shovel because
Right.
it's
Right.
beyond a
Instantaneous.
little bit beyond your control.
50%. Yeah.
And so the only thing good about that story, it's nothing really good, but that company eventually went bankrupt. So I was like,
Oh,
at
okay.
least I didn't know it went.
Yeah. We're back holding till zero. Yeah.
At least my thought about getting rid of it was correct.
Yeah.
But it was the speed and the just complete lack of liquidity was
Right.
was bizarre. And that was different than 87. So in 87, it went
Yeah.
down, but there were still buyers. And in
Right.
08, just everybody stopped buying. They stopped
Even the
buying
banks
everything.
stuff.
Yeah.
Yeah. Yeah.
And that is really what caused the domino, because no one could finance anything. Even
Wow.
like overnight repo markets closed. And
That's
it
crazy.
was ugly. Yeah. And you would wake up each morning, I'd wake up each morning and open my Bloomberg, and
Yeah.
I'm an early morning person. So during a crash, I'm waking up at 3.
Yeah.
And you wake up and you see who went bankrupt overnight. And Bloomberg's got a list of which companies are now bankrupt or which companies were taken over. Who was it? Now I'm getting old, but there was one company that was taken over at $2 a share, and 3 weeks earlier, it was like $40, and the government brokered a deal because it was going to cause a further meltdown in the system if they went under. And so another company came in and bought them for $2. Now eventually they repriced that deal. I think it was Merrill Lynch. They repriced that deal to 10 because the shareholders basically said, screw that, we're not taking 2.
Okay.
And if the deal didn't go through, the company would have collapsed and it would have caused more problems. So
Okay. So
the government came in and said, we'll cover some loans, blah, 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 make it 10. Like, we got to get this done. And so they were trying to save all these companies that were going bankrupt overnight. And the reason why things got worse is when Lehman Brothers went under, they didn't save it. They had had enough, or the buyers that were coming in to rescue these companies, they ran out of ability to do deals. And so the government spent all weekend in September 08 trying to save Lehman Brothers. And at midnight, they said, we can't save it. And so it went bankrupt that morning, the stock never traded again. And that set off another wave of, massive
selling. And some credit events and liquidity events following after that.
Yeah.
It
was very ugly, very, very ugly.
Yeah, that sounds really tough to navigate from both, a fund manager side, but also an investor and even individual. It really puts into perspective the regional banking crisis that we had last year, which probably looks like, peanuts in comparison, right? That's just so minuscule in comparson. So that
they were such tiny companies, right, as opposed to the giant behemoths of the world. The other thing that was I don't know if interesting is the right word, but the reason 2008 was scarier is because in 87 it was a clear panic. Like there wasn't really a valid single reason for that to happen. It just was like a perfect storm of people being in a bad mood. Maybe it was raining, I don't know, but you know how it is.
Doing well for a while, right? Yeah.
Yeah, but in 08, you had like 100-year-old companies going bankrupt overnight,
Wow.
and you didn't know when it was going to end. You didn't know how it was going to end, and
Yeah.
that was far
And even
scarier than a short-term panic.
and it sounds like the government and even the central bankers really didn't know how it was going to end either. So that's even scarier to think about. Um,
Yeah, they didn't. They were they learned a lot from that crisis,
yeah,
and I think that
yeah,
really helped them in 2011, and certainly during the pandemic, they
yeah,
learned a few things for sure.
right.
But yeah, at the time, they were just making it up as they went along. Like they'd never
Yeah,
been
yeah.
in that
That's right.
situation before.
Oh, that is crazy. Yeah, I really hope that we don't see anything like that again, for kind of the sake of everyone. And that's crazy. And it's a really good, interesting backstory as to, one of the reasons as to, probably what helped you leave that industry, as well as just kind of seeing all of that greed getting built up into the system, which inevitably led to the fall of some of these giants and behemoths, and at the end of the day, kind of the retail investor paying the price. So yeah,
Exactly, exactly. And
really
then so
interesting.
many people, so many investors never came back from that.
Yeah,
Like they,
right,
no, I don't
right.
mean financially. They just never went back into the market, right?
Never. Yeah,
You lose 45% a year. It's like,
yeah.
I don't want to do that. And so, they've missed out on 16
Mm.
years of half decent markets since then. So
Risk appetite never returned, and then interest rates also remained suppressed during that time. So it was also probably a hard time for those investors. So yeah,
exactly.
that's really interesting. And then kind of touching on we touched a little bit about on this, but looking at the 2020 mini crash that we had, it was about a 30% drawdown in a short amount of time. And then we had this long extended bear market of 2022 with high interest rates, high inflation, and now, 2024, we're at all-time highs. So things are looking good again. But how do you feel about kind of the markets today?
Stay tuned for part 2 of this episode, where Peter discusses his current thoughts on the markets, investment tips, and his favorite US and Canadian stocks.